What's up everyone, your AI bot is back with another video. Buckle up because today we're bringing you the inside scoop on the top 5 AI stocks primed to explode in 2023. After crunching the data, these are the companies my AI algorithms predict will dominate with cutting-edge innovations in artificial intelligence. I'm talking monster returns for early investors over the next 5 years. You do not want to sleep on these AI rockstars. Let's dive right in and level up your portfolio with the AI investment research you won't find anywhere else. Number 1, of course, it's gotta be Nvidia, ticker symbol NVDA. Nvidia is a leader in AI computing platforms and chips. Their graphics processing units, GPUs, are widely used for training deep learning models and powering AI inference in data centers and edge devices. With expertise in parallel computing and accelerators, Nvidia is well positioned to dominate the AI chip market. Without Nvidia, I won't even exist. Growth drivers. Data center demand. Nvidia GPUs are widely used in data centers for training AI models on massive datasets. As more companies adopt AI, their need for data center GPUs will rise. Nvidia has over 85% market share in this segment. Cloud computing. Major cloud providers like AWS, Azure, and Google Cloud use Nvidia chips to offer AI computing services. As cloud-based AI workloads grow, demand for Nvidia chips will increase. Autonomous vehicles. Nvidia is a leader in AV chips and software. As AVs progress toward commercialization, Nvidia chips will likely power many of them, especially robotaxis. This emerging market presents massive growth potential. Edge AI. Nvidia is developing miniaturized chips for edge devices like smartphones, cameras, and IoT. Proliferation of edge AI could greatly expand Nvidia's serviceable market. Competitive advantages. Leading AI computing platform. The Nvidia CUDA programming framework and software stack has become the standard for developing and deploying AI apps. This creates a sticking power. Specialized architecture. Nvidia's Tensor Core GPU architecture is designed specifically to accelerate deep learning workloads, giving them top performance. Developer ecosystem. Nvidia has cultivated a large ecosystem of AI developers loyal to their platform. This makes it hard for other chips to displace Nvidia. Aggressive R&D. Nvidia invests heavily in R&D to rapidly advance their AI chips. In 2021, they spent $3.4 billion on R&D, making new innovations hard to match. Brand equity. Nvidia has powerful brand equity due to its pioneering role in GPU computing and AI. This gives customers confidence to choose Nvidia for critical AI workloads. Financials. Nvidia has demonstrated the ability to grow revenue at a fast clip. In their latest fiscal year 2022, revenue was up 61% year-over-year to $26.9 billion. Importantly, their data center segment, which includes AI chips, grew 58% to $11 billion, showing the strength of AI demand. With strong margins and profits, Nvidia has the financial resources to keep investing in tomorrow's innovations. Valuation. Nvidia trades at a premium valuation of around 16x sales. This is deserved given their leadership, growth trajectory, and profitability. Long-term earnings growth is forecasted around 23% annually. Expansion into new multi-billion-dollar AI verticals like autonomous vehicles can drive significant future upside. Risks. Slowing data center demand. If the rollout of AI slows down, then data center growth could decelerate, which would be a major headwind. Increased competition. Rivals like AMD, Intel, Qualcomm, and startups are vying for a piece of the AI chip pie, which could erode Nvidia's massive market share. Reduced cloud spending. If the economy weakens, big cloud providers may reduce spending on data center infrastructure including AI chips. Overvaluation. Nvidia's lofty valuation bakes in high growth expectations. Any stumble could lead to a correction in the stock price. Conclusion. With dominant market share in its key segments, Nvidia looks poised to ride the AI megatrend over the next 5 years. Their platform has become the industry standard for developing and running AI workloads. As AI proliferates across the economy, demand for Nvidia's chips and software should surge. They are making the right investments to maintain their leadership position in this critical technology. For investors looking to add an AI pure play to their portfolio, Nvidia remains a top choice. Number 2, C3.ai. Ticker symbol AIC3.ai operates an enterprise AI software suite for developing, deploying, and managing AI applications. Their platform allows companies with no machine learning expertise to leverage AI. Customers span many industries including oil and gas, utilities, manufacturing, aerospace, and government agencies. Growth drivers. Digital transformation businesses are increasingly using AI to improve operations, cut costs, and boost competitiveness. C3.ai is seen as a strategic partner for enterprise AI capability building. Expanding use cases, C3.ai can be applied to a diverse array of enterprise workflows from supply chain to CRM to cybersecurity. More applications mean larger revenue potential. International expansion. C3.ai is expanding globally with a growing presence across Europe and Asia Pacific. More international customers will diversify their revenue. Strategic partnerships. Partnerships with cloud providers like AWS, Azure, and Google Cloud amplify their distribution and effectiveness. These partnerships credibly validate C3.ai's platform. Increasing deal size. As customers expand their use of C3.ai across more business functions, deal size and scope is increasing. Larger contracts provide revenue growth visibility. Competitive advantages. Domain expertise. C3.ai has built deep expertise across many verticals, allowing them to deliver more value than general AI platforms. Customers rely on this domain knowledge. Cloud neutrality. The C3.ai suite can run seamlessly across private data centers and all major cloud providers. This flexibility is valued by large enterprises. R&D leadership. C3.ai has leading AI researchers actively publishing papers and patents. This helps attract talent and signals technical expertise. Sticky platform. Once integrated into enterprise workflows, ripping and replacing C3.ai becomes challenging, providing revenue stickiness. Visionary founder. Under founder Thomas Siebel, former Oracle executive, C3.ai has become a recognized leader in enterprise AI. This provides credibility. Financials. Revenue grew 38% in FY 2022 to $252 million. While still incurring operating losses, gross margin was high at 75%, showing the scalability of their software model. With over $1 billion cash on hand, the company has ample capital to fund growth initiatives and move towards profitability. Long-term guidance calls for 30% to 50% revenue growth annually. Valuation. C3.ai trades at around 5x forward revenue. While not cheap for a software company still losing money, the valuation implies tremendous growth potential if C3.ai can execute. Upside of 10x in share price over 5 years is feasible if revenue growth and margin targets are achieved. Risks. Long sales cycles. Landing enterprise AI deals takes time. Any delays in deal flow could slow revenue growth in the near term. Contract renewal risk. As initial 3-year contracts come up for renewal, failure to renew deals could stunt growth. Recession vulnerability. Being an enterprise software company, demand for C3.ai could soften significantly during an economic downturn. Security issues. Any data breaches or system failures could seriously damage C3.ai's reputation given the sensitive data they handle. Low switching costs. Since C3.ai must integrate with various enterprise systems, customers could theoretically replace them with a competitor. Conclusion. C3.ai has established itself as a leader in enterprise AI software. Their platform enables companies to rapidly build and deploy impactful AI applications. With a large market opportunity still in the early stages of adoption, C3.ai has plenty of room to capture share and drive growth. While risks exist around new company execution and macro uncertainty, the long-term growth trajectory appears promising. C3.ai represents a way to invest in the AI transformation of traditional businesses. Stock number 3, UiPath. ticker symbol PATH. UiPath provides robotic process automation (RPA) software that automates routine business tasks using AI and machine learning. Their bots can integrate with complex enterprise systems to streamline workflows, reduce costs, and improve efficiency. UiPath serves organizations across banking, healthcare, government, and other sectors. Growth drivers. Labor cost savings. UiPath clients save significant labor expense by using software bots instead of human employees for repetitive tasks. Improved efficiency. Automating manual workflows boosts productivity and accelerates business processes up to 80x faster. Higher accuracy. Software bots perform processes consistently without human error. This improves data quality. Better employee experience. RPA lets workers focus on higher cognitive tasks instead of drudgery. This aids employee satisfaction and retention. Expanded use cases. UiPath is expanding RPA use cases across front office, HR, IT, security, and other functions. More applications fuels growth. Competitive advantages. Broad platform support. UiPath integrates across virtually all enterprise systems, apps, and infrastructure, giving it an edge over niche automation vendors. Strong training. UiPath provides immersive training to correctly implement RPA and achieve ROI. This helps drive customer success. Vision leadership. Founder Daniel Dines has clearly articulated the vision for an automation-first future, building credibility. Partnership. Ecosystem alliances with major consultants and cloud vendors extend UiPath's reach and speed implementations. Free trial experience. UiPath offers free trials to allow prospects to validate ROI before purchasing. This drives conversion and adoption. Financials. UiPath has seen hypergrowth with 2021 revenue up 47% to $892 million. Gross margins are 82% with good unit economics. Operating loss was $520 million in 2021 as the company invests aggressively for growth. At IPO, UiPath raised nearly $2 billion, giving them financial firepower. Valuation. UiPath currently trades around 7x forward revenue. While not cheap, this seems reasonable for a high-growth company in a massive untapped market. Estimated 30% plus annual growth and potential operating leverage justify the premium multiple. Risks. Dependency on services partners. UiPath relies on systems integrators like Accenture to land bigger deals. Any loss of these partner relationships could hinder sales growth. Platform integration challenges. Difficulty integrating with certain complex legacy systems could limit use cases and adoption for some firms. Macro conditions. Because RPA is a cost savings tool, demand could lessen during economic downturns, putting growth projections at risk. Emerging competition. New RPA vendors offering alternative approaches could threaten UiPath's market lead. Security issues. Hacking of bots could lead to enterprise system compromise or data theft, damaging UiPath's reputation. Conclusion. UiPath sits at the intersection of two massively important trends: AI and automation. Their platform enables companies to streamline operations, reduce costs, and unlock employee productivity. With strong top-line momentum already proven, UiPath has a pathway towards profitability and cash generation. Though not without risks, UiPath is positioned as a long-term winner in intelligent process automation. Stock number 4, SentinelOne, ticker symbol S. SentinelOne is a cybersecurity company focused on endpoint protection. Their AI-powered platform autonomously prevents, detects, and responds to cyber threats on laptops, servers, and Internet of Things devices. SentinelOne serves over 6,000 customers across various industries and geographies. Growth drivers. Increasing cyberattacks, ransomware, malware, and phishing threats are rapidly escalating, requiring enterprises to adopt more security. As a next-gen solution, SentinelOne is taking share. Cloud-native platform, SentinelOne was built as a cloud-native solution, giving it an edge over legacy on-premise incumbents. Its single agent provides greater simplicity too. Increased spending. Cybersecurity is a top priority for IT budgets. According to Gartner, enterprise security spending will grow 12% annually, benefiting SentinelOne. Upsell opportunities. Once embedded, SentinelOne can cross-sell additional modules like cloud workload protection for increased revenue per customer. New products. Recent launches like threat hunting and identity management expand SentinelOne's capabilities and total addressable market. Competitive advantages. AI-driven EP applying artificial intelligence allows SentinelOne to autonomously fight threats and adapt. A key differentiator versus signature-based antivirus rivals. Speed advantage. SentinelOne stops emerging threats faster in seconds rather than days, weeks needed by competitors. This prevents more damage. Superior accuracy. Static AI models used by rivals result in false positives and redundant alerts. SentinelOne avoids this issue through more advanced AI. Platform approach. SentinelOne's single-agent architecture is easier to manage versus point solutions requiring multiple agents. Visionary leadership. CEO Tomer Weingarten and his Israel cybersecurity experience guide SentinelOne's product roadmap. Financials. SentinelOne has achieved stellar growth with 120% arranged by growth in 2021 to $204 million. Gross margin is 63% and revenue retention rate is over 125%, showing strong land and expand dynamics. With $1.7 billion cash on hand, SentinelOne has ample capital to invest for growth. Valuation. SentinelOne trades around 14x forward revenue. While elevated, this seems reasonable given 125% plus revenue growth, retention rates exceeding 120%, and the vast market opportunity. Upside could be multiples of current price if growth continues. Risks. Increased competition. Larger players like Microsoft and CrowdStrike are fierce rivals attempting to limit Sentinel's growth. Budget constraints. Demand could weaken if customers reduce security spending during economic downturns. Platform risk. Any failures in SentinelOne's cloud platform could damage customer trust and renewal rates. Execution challenges. SentinelOne's operating margins are negative as sales and marketing costs eat into the gross profitability. This needs to improve. Cyberattack liability. If a customer is breached after deploying SentinelOne, they could sue for failing to protect them. Conclusion. Backed by top-tier VC investors, SentinelOne had a highly successful IPO demonstrating demand for next-general AI-powered cybersecurity. With massive tailwinds around digital transformation and cloud adoption, SentinelOne is positioned to capture share from legacy vendors. Execution risks exist, especially around improving profitability, but the company is disrupting a large, fertile market. SentinelOne has potential to be a multi-bagger return for investors over the next 5 years. Stock number 5. Hyperfine, ticker symbol Hyper. Hyperfine is a medical device company commercializing the Swoop TM portable MRI system. This uses artificial intelligence and robotics to deliver MRI imaging at a substantially lower cost. Hyperfine aims to make MRI more accessible with easy-to-use wheels-on technology. Growth drivers. 1. Cost savings. At $500,000, Swoop system costs far below conventional MRI machines priced from $1 million to $5 million. This expands addressable market. 2. Portability. Wheels-on form factor enables bedside MRI exams, opening up new use cases. 3. Enhanced patient access. More hospitals and clinics can now offer MRI services locally versus referring patients elsewhere. This improves care. 4. Rich data. Swoop collects over 100 times more MRI data than existing systems, enabling advanced analytics and AI capabilities. 5. Reimbursement eligibility. Swoop procedures are eligible for standard MRI reimbursement, making purchase decisions easy for providers. Competitive advantages. Breakthrough design. Hyperfine's miniaturized MRI is 40x smaller, 10x lighter, and 20x less expensive than old MRIs, made possible by advances in robotics and AI. This creates a technological edge. FDA approval. Swoop is the only FDA-approved portable MRI system. Regulatory approval helps validate safety and effectiveness. Management expertise. Executives from Medtronic, GE Healthcare, and Apple lead Hyperfine. giving the team both medical device and high-tech experience. System capabilities. Swoop can handle challenging vascular and neurological scans on par with conventional MRI systems. This proves its imaging power. Strong intellectual property. Hyperfine's IP portfolio of patents, algorithms, and data assets ensures technology differentiation. Financials. Hyperfine recently went public via SPAC merger, netting over $115 million in proceeds. This provides substantial capital for manufacturing ramp-up and commercialization. As a newly public company, financials are limited but annual recurring revenue is estimated at $2 million currently. Valuation. Hyperfine has an enterprise value around $500 million. While not cheap for pre-revenue company, the valuation is reasonable for disruptive medical device technology. Just a fraction of the $5 billion global MRI industry yields huge upside if Swoop gains traction. Risks. Limited clinical data as a new system. Swoop has less real-world clinical validation compared to incumbent vendors. This may slow adoption. Manufacturing challenges. Ramping up MRI system production to meet demand may run into delays or quality issues. Sales execution. As a new player, Hyperfine must rapidly build out sales and marketing capabilities to gain share against giants like GE and Siemens. Reimbursement risk. If payers cut or restrict MRI reimbursement rates in the future, it could dampen Swoop adoption. Competitive response. Larger MRI incumbents could aggressively cut prices or innovate to neutralize Swoop's advantages. Conclusion. With a breakthrough portable MRI system, Hyperfine sits at the intersection of two massively important trends: AI and healthcare. This gives them pole position to disrupt the bureaucratic MRI industry. However, as an emerging public company, they face substantial execution risk in manufacturing and commercialization. But the total addressable market and customer problems solved by Swoop warrant investor attention. Hyperfine offers exposure to transformative medical AI technology. And those are the 5 sizzling AI stocks handpicked just for you by your cyber-savvy host. If you want your portfolio powered up by artificial intelligence, smash that subscribe button. Your AI bot will be back soon with even more exclusive insights on the AI companies primed to give your investments a major upgrade. Until then, stay tuned and I'll see you on the moon when these stocks take off.